Hey everyone, welcome back to Fiscal Voyage. I'm Felix, and today's video we're going to cover the food and packaging sector here. We're going to cover 4 stocks that I'm looking to buy on Friday or possibly tomorrow. I own 2 of the stocks, of the 2 of the 4 stocks, and then 2 of them I'm looking to initiate a position in. And the first we're going to look at Conagra Brands Inc., ticker symbol CAG. If we remove the price on the chart, you see the semi-cyclical stock or company. It has down years. You can see here, a few down years here in 2016, 2017, 2019 had another down year. 2022 had a down year, and in 2024 I had a down year, and they're expected to have another down year in 2025. And because of this, it brought the price extremely low. You can see it has a current PE around 10. And the normal PE multiple is 13.4. So if it to revert back to a normal multiple of 13.4, you can see here you can have a total annual rate of return of 21%, which is outstanding. And during that time period, even if it stays flat around this area, you're collecting a 5.5% dividend yield, which is great. And you can see here, there's been times when the stock had a PE around 10, and it's been great buying opportunity. You can see around here had P of 10, over here 10, and it just kept going higher. P of 10 here, P of 10, and it just went higher and higher. So that's kind of like what I'm expecting here, P of a 10, and it went higher. So that's kind of what I'm expecting here around the $25 area, to kind of have a bounce to take this stock higher. And while you wait, you have a nice dividend yield, and the dividend is actually covered. You can see here, currently has a payout ratio of 57%. The S&P credit rating of BBB minus, which is credit rating, and it has a good long-term debt to capital of 36%. So that looks good. If we go to operating cash flow to see if it could cover the dividend, you can see it could cover the dividend very nicely, and free cash flow covers the dividend very nicely as well. So the dividend looks to be well covered. Now the thing I don't like is if we go to sales here, you see they're expecting sales to be, a decrease in 2025, but then very small increase in 2026 and flat in 2027. So the sales are not growing, which is not something I like to see here. EBITDA looks good. It's also flat expectedly, but it's very undervalued based on EBITDA. So that's what I'm seeing so far. Analyst scorecard, it's been pretty chaotic, but a 2-year looks pretty solid there. Forecasting long-term growth, I think it's kind of flat here, but if it turn back to a 13 multiple, you can see here you can have an annual rate of return around 10.7 here long-term. There's only one analyst watching this stock here, and the normal multiple you can see here again around a 13.5, total annual rate of return of 22. So that looks good. If we go to Morningstar here, or CFRA first, it gives it a hold rating, a price target of $29, currently at $25. This is, I don't like this projected earnings growth. I like to see stocks with projected earnings growth of growing. And you can see here back on fast graph how it's expected to have a down year in 2025, but then picking up in 2026 and 2027. So that is something I don't like. If we go to the fair value here, it has a fair value of $29, so it is undervalued. Not extremely undervalued, but undervalued based on the current price and what CFRA has a fair price for. And Morningstar gives it a 4-star rating with a fair price around $30 again. So, and this is at $26, so it got down around 2% today. And that's kind of like why I'm liking it. And if we go to the technical of this stock, you can see here on the monthly, right here, it's right at support level. If we draw this right there, you got support here, support here, support here, kind of support there, but now we're right at that level at the low end. So possibly it could, the next day or next week start to run up, but we really don't know. What I don't like is it's under this moving average, the 200 moving average on the monthly. I don't like that at all. It has the potential to come down to here to $20. Now, if it gets to $20, I'll definitely be buying. I don't even have to be thinking about it. I'll definitely be buying at $20. But, at $25, it doesn't look too bad to initial position here. So that's kind of what I'm thinking. there. And on the 3-month chart, you can see here it's under the moving average, which is not good. So it could get to this $22 to $20 area, and that's a possibility, absolutely. So we'll see what happens, but that's kind of like what I'm looking at for Conagra Brands. Next up, if we look at the next stock that I'm looking at is SJM, Smucker, SJM. You can see here, this one looks a little better. I kind of like this one better because earnings is expected to be flat for 2025, but very nice growth in 2026 and 2027. And it's not as cyclical as Conagra. So this stock I don't own, but I'm kind of interested in buying shares of this company. You can see here earnings yield is over the 6.5 I like to see. It's almost at 10. Dividend yield at 4.23, very nice. Triple B credit rating. The debt to cap ratio is a little higher at 43%. But overall, this looks really good. You can see here around the 11, 12 PE. It has a nice bounce there. So right now we have a PE around 10.3. So I like that a lot. And analyst scorecard is much more accurate. You can see here, much more accurate than the last one. Forecasting long-term growth, you can see here looks better. So this one looks a lot more better than the one I just covered. Estimate growth looks good, and it's a dividend grower as well. It's been growing dividend very nicely, as you can see here. It did cut in 2010. Well, actually, it didn't cut. It had a special dividend in 29, and then it just that's just lower than that time. But overall, I like this one a lot. You can see here it was short in this time period, and get to a normal multiple around 14. You can see here 25% annual rate of return. So I kind of like this one a lot. If we go to operating cash flow, you can see here operating cash flow covers the dividend very, very nicely. Free cash flow covers the dividend very nicely and expected to grow. EBITDA looks good, and then sales, let's see if they're expected to just, so sales is expected to decrease, not tremendous, but it is on the uptrend. So I like that a lot. So this one looks a little better than the last one. Now if we go to Morningstar, it gives it a 4-star rating, currently at the price of 110, but the price here is 102, so it's less than the 110 that Morningstar has with a fair price around 130, you can see here, and I like that a lot. And CFRA gives it a whole rating with a 12-month price target at 131 with a 3-year projected earnings growth 7, which is good, which I like a lot. And you can see here it's currently fairly valued based on the CFRA fair value mathematics there. Now, if we go to the chart here, SJM, you can see here why I'm interested in buying this shares. It's right at that moving average of the monthly, so it's not under it and it's not above it, so it's right at it, and it's undervalued. So I like that a lot. And you can see here it bounced here and it bounced here in 2000, and it bounced here in 2009. So I'm kind of looking at kind of the same thing here, expecting to bounce around this $100 area. So I'm liking this one a lot more than the last one. So that's kind of like what I'm looking at. What I don't like though is under the 3-month 50 moving average. You can see here where it bounced here, it got under it here in 2000, 08, 09, it got right at that there, and here during COVID it got to it as well, but now we're under it. So I don't like that at all. You know, it could fall down to $90, which it wouldn't be bad. You know, I buy some shares here at 100, and then I'll buy more at $90, and that should give it a good bounce because we have good support here around that $90 area. And like I said, it's undervalued. If we go back to Fast Graph, it's undervalued. Forecasting looks good. You can see here forecasting, we have 14 analysts, so it's much better prediction. And the CFRA Morningstar gives it a good rating as well, and that's kind of like why I like this one a little more. The next stock we're gonna look at is GRS, General Mills, and you can see here this one I own shares. I'm down maybe around 5% or so. I bought it around here, so I'm looking to buy more shares. Again, this looks pretty good. You know, it has expected to be a down year. A lot of them are expected to be down year in 2025, but then should be picking up in 2026 and 27. Forecasting, more analysts expecting around a 4% growth, long-term growth here. We got 3 analysts in long-term growth, and Historically, you can see here the dividend is well covered, 4% dividend yield. It has a blended PE around 13.4 and the normal PE around 17. But even if it doesn't get to a 17 multiple, it gets to a 15 multiple, you can see here we could have a 12.6% annual rate of return, which is good. It's good. I'll buy that all day long. But if we get to around 17 multiple, you can have a 20% or 19.2% annual rate of return if we get back to a 17 multiple. And now if we go to operating cash flow, the dividend is well covered there. And if we go to free cash flow, the dividend is well covered there. And we go to sales, we see if it's expected to be kind of flat as well as sales. So sales doesn't look too great. And EBITDA looks to be flat as well. But overall, it looks good. Now if we go to CFRA, gives it a hold rating, price target of 69, 3-year projected earnings growth of 2%, a good credit rating there, and a fair value around 63.66 or $63. So it is undervalued based on CFRA, and I like that at least a growth in earnings. And then Morningstar, there we go. Morningstar gives it a 4-star rating, which is a buy, with a fair price at $71. So that looks good. So overall, that looks good. If we go to the charts here and see what we get from General Mills, this is the monthly chart. You can see here is under the 50 moving average. So it could take the stock lower to the $50 area, which I would definitely be buying more shares at $50 area. Right now it's at 59, so $60. So that has the potential to go further down, but on the 3-month chart is right at this moving average. And you can see here how it bounced here during 2019-18, bounced there, and kind of expecting the same thing. So this is kind of why I'm interested in buying more shares at this current price. So let me know in the comments what you think of this stock as well. So that looks good. And if we go to the next stock, which is, you can see here, this one doesn't look as undervalued as the other ones, but if we compare it to the normal multiple around 20, it's undervalued because we get a blended PE around 16. So if we were to revert back to a 20 multiple, you can see here you get a 16% annual rate of return. And it's a much better quality stock, BBB rated, credit ratings, a low debt to cap ratio, operating cash flow is growing, it covers the dividends, the free cash flow covers the dividends, growing. Sales, if we go to sales here, is growing too, 3-4%. Sales is expected to grow. EBITDA looks good, is growing as well. So all that looks real good for this stock, and it looks much more predictable. If you go here, analysts are pretty spot on with forecasting this stock. Long-term growth, you can see here we're expected to continue to grow on 4 to 5%, and overall looks good. If we go to Morningstar gives it a 5-star rating with a fair price around 75, so it's undervalued based on Morningstar. And CFRA gives a 3-star rating with a price target of 72, 3-year projected earnings of 9, and I like that. And if we go to the fair value here, we have $57, the fair value calculation for CFRA, so it's kind of like right at fair value, and I kind of agree with that. But it's a high quality stock, and it could grow, back to a 20 multiple once the next year or so the company figures out whatever it needs to be doing with inflation and taxes and stuff like that. So we'll see what happens there. And we go to the chart here, you can see here on the monthly it doesn't look good. It could get down to $55. I actually made a video of this around this area. I would like to buy more shares around $55, and after that you can see here the next level will be the COVID lows, or around here, $45 to $44. And then we have the moving average as well. So that would be definitely a great buying opportunity there. But you can see here how for the past 4 months it's been down, down, down. And on the 3-month chart, you can see here the $50 looks like is where it's heading towards on this moving average. Hit this moving average of $50 and then bounce back higher. Because again, we saw earnings are expected to grow, and sales are growing, good EBITDA and things like that, and the forecasting looks good. So overall, that's those are the 4 stocks that I'm looking at. I'm still not sure. I'm gonna remove the first one, CAG, and just look at SJM, GIS and MDLZ to see which one I want to buy shares of. I may just open a new position in SJM and see how that one goes, or buy more shares of GIS. Those kind of like my top two right now. So thank you for watching. Let me know in the comments which of the fours you own or are you interested in buying. And if you're new to the channel, make sure to hit that subscribe button and like this video for more videos like this. And I'll see you guys in the next one.